What if your accountant has been quietly saving you thousands of dollars a year and you didn't even know to ask? S-Corp distributions might be the most underused tax strategy sitting right in front of self-employed business owners. And today, we're pulling back the curtain. Here's the setup. When you're self-employed, the IRS taxes every dollar of your net profit. With self-employment tax, that's 15.3% on top of your income tax. We're talking Social Security and Medicare, and you're paying both the employee and the employer side all by yourself. Now enter the S-Corp election, the move that changes the whole equation. Instead of all your profit being subject to that brutal self-employment tax, you split it. Part goes to you as a reasonable salary, and the rest flows to you as a distribution that sidesteps self-employment tax entirely. Think of it like a two-bucket system. One bucket gets taxed heavily, and the other one, the distribution bucket, gets a much lighter touch. The IRS knows about this strategy, they allow it, and millions of business owners are using it right now, while others are just handing over extra money for no reason. The catch, and there always is one, is that word reasonable. The IRS requires that you pay yourself a reasonable salary before you take any distributions, because otherwise everyone would just take $1 salary and $1 million in distributions. If your salary is laughably low and your distributions are suspiciously high, that's the kind of thing that gets flagged, audited, and reversed with penalties. So what does reasonable actually mean? It means what someone in your role, in your industry, with your skill set would typically be paid. Think industry surveys, Bureau of Labor Statistics data, and comparable job postings, all of which your CPA should be using to defend your number. Here's where it gets interesting from a historical standpoint. The S-Corp tax strategy has been around since 1958, and yet as recently as 2020, studies showed that fewer than 40% of eligible small business owners had made the election. That's decades of legitimate tax savings left on the table, which is either inspiring or deeply depressing, depending on how long you've been in business. The common misconception is that this is somehow sketchy or aggressive tax planning. It's not. It's literally written into the tax code for this exact purpose. The IRS isn't hunting down S-Corp owners for taking distributions. They're hunting down the ones who abuse the strategy by paying themselves $200 a year and calling it reasonable. Let's talk real numbers for a second to show you why this matters. If your business earns $200,000 and you pay yourself a reasonable salary of $80,000, only that $80,000 is subject to self-employment taxes. The remaining $120,000 in distributions is not, which could mean over $18,000 in annual savings. Now, before you sprint to your accountant screaming, "Convert me," pump the brakes just a little, because S-Corp status comes with costs. You'll have payroll setup fees, quarterly payroll tax filings, an additional corporate tax return, and compliance requirements that can run anywhere from $1,000 to $3,000 a year, depending on who you hire. The math still works for most people, clearing over $40,000 to $50,000 in net profit, but the break-even point is real and worth calculating before you make the move. This is a strategy built for discipline, not desperation. It rewards the business owner who runs a tight ship, tracks everything, and actually pays themselves consistently. Here's the philosophical truth underneath all of this. Taxes are one of the largest expenses in a self-employed person's life. And unlike rent or payroll, they're an expense you actually have legal tools to manage. The business owners who build long-term wealth aren't necessarily the ones who earn the most. They're the ones who keep the most through smart, consistent, boring, unsexy strategy. Don't wait until December to think about this. Tax planning is a year-round game, and the S-Corp election for the current year has a deadline that most people blow right past. The best time to explore this was last year. The second best time is a conversation with your CPA this week. If you're already an S-Corp and you haven't revisited your salary in a few years, that's its own problem, because as your revenue grows, so should your reasonable compensation, and an outdated salary is just as risky as one that was never set correctly. Stay proactive, stay compliant, and treat your tax strategy like you treat your best client, with regular attention and a little bit of respect. And if you're ready to stop guessing and start building, whether that's structuring your business the right way, investing in real estate, tackling a renovation project, or finding the right lender to make your next move, check out our links in the description below, because we can help you get started.